and they don't keep increasing, the kind of, or something new doesn't keep coming up, then I'll be okay. Okay, let's wait and watch. But the rope which I will give to such a company will be much less. Let's say if the management, first of all, you are a little, concerned about the management, that the compensation is too high. And I'll give an example here. We don't hold the stock. Example is Amar Raja Batteries. Again, he, as a advisory and as a personal investor, I bought it in 2011. The compensation for that particular management is at the last time I saw was very high. It is quite a, a large proportion of their net profits. I think if I remember correctly, maybe it's 8, 9, 10% also. And this was a time when Amar Raja Batteries was doing very well. They were challenging the leader, which is Exide Industries, and they were gaining market share quickly, right? They went into retail. They started promoting their brand. So this is 2010-11 time frame. Compensation was very high, and the management, actually the promoters, are also, they are also, um, they also have political ambitions. Now, in the past, this would have been, both these points would have been a deal breaker. I would not proceed. This time around, I said, let me start a position. Let me monitor it closely. As long as the execution happens and things don't go in the wrong direction, I should be, we should be okay. So I kept holding it, and as long as the company kept growing, I was holding it, and then finally we exited. So that has been the change, where I will be far more tolerant as long as the management is executing. So Ankit, hopefully this answers the question.
Yes, thanks, Rohit. So that really helped. And my next question would be again regarding to the cash position in your portfolio. I think you have written about it in your blog also, and
Right, right,
recently you did a webinar with Ishmohit of SOIC, and there also you covered a fair bit of it. But I think I'll just
right,
add another angle to it. So
right,
I'm sure there are different types of investors, and there are people who would be 100% invested all the time, and
right,
then
right.
there are people like you who would always try to take a cash call as to.
Hmm.
So when you take a cash call, how much of it is due to the macro scenario, or
Right,
you find it difficult to find individual opportunities? How do you look at that?
right. Yeah. No, that's a good question. I think I'll approach it a little differently. So you remember the 3 points which I mentioned:
Yeah.
time horizons, cyclicality, and return on time invested, right? So there is another fourth point also, which is, I keep talking about it with my friends, with my investors. End of the day, can I sleep well? And that's a very loose term, but my point is, and my, I use sleep well as a thumb rule for risk management. If I lose sleep over my portfolio, then it is not worth it. That was important 25 years back when I was starting, and it's important now also. In the end, investing should be a means to an end, right? It cannot be a roller coaster where, you're scared out of your mind because you are so heavily invested. So some people, again, some people have, they can handle risk. Again, risk is a very subjective term. It varies based on age, it varies based on an individual. What Somebody can be 110% invested with 10% leverage and will be like calm like a Buddhist monk, right? And somebody like me would be 80% invested and will be still nervous, right? So point number one is, it is a very personal decision. So in my case, my thumb rule is, am I comfortable with, at that point of time, like with the level of cash, or with the level, it's a broader part of my overall portfolio allocation. How much do I have in equity, how much do I have in cash, how much do I have in other asset classes? So first of all, at a very broad level, it comes from there. The second is, I usually don't look at a macro situation. It's a bottom up function of what kind of ideas I'm finding, and can I invest based on that. So as, let's say, if the market starts dropping, or if more bargains are coming up, I will, my cash position will start reducing. And as the companies which I hold start getting overvalued, or I think, the risk reward is not good, I will start selling. So usually cash for me is an outcome rather than a call, right? It's not like, uh, let's say, 2023 is expected to be so and so, these are the macro risks, etc., etc., and I come up with a cash number. It's never that. It's bottom up saying, can I find extra companies, and if I can find the companies to invest in, I will start buying them till I run down the cash. It's just so that a lot of times I've ended up with some cash, but usually it's not very high. It may be 10-15% at max, maybe 20% at the peaks, but I'm usually invested to that level. So it's an outcome. It's not really a macro or a call which I make. And again, comes to the same point. Am I comfortable with what I'm doing? If I feel nervous about it, I will. And that nervous is usually again a subjective thing, right? I mean, what can make one person nervous, the other person will not care, right? So, and that's what I've usually seen it work, right? There's no point in trying to come up with a precise number, right? Because each one of us will think differently.
So, Rohit,
Right.
I have a
Rohit,
question on
uh,
this. So, Ankit, Rohit,
yeah, Prince, you can go ahead if you have a question, or shall I go ahead first?
question
Okay.
which you asked. Okay. So, Rohit, you talked about being conservative in your approach, which is fine. And when it comes to allocation, you also say allocation matters. The overall return on the portfolio is one thing which matters. So, is it being conservative is an hindrance to betting big, or how you manage on that? I mean,
I have occasionally bet big. It's not that I have not. Uh, it again comes down to the point of, I believe a lot in on longevity of being able to see. That is the other thing, right? If you uh, uh, the good thing about being an investor in India is that you have to avoid doing something, stupid, right? Which is, you should not get knocked off the game, right? And when I say knocked off the game, I think the most important thing for all of us as investors to understand is that you will run out of willpower before you run out of money. Let's say, just as an example, right? We are lucky that this did not happen in India, but it has happened in a lot of global markets, right? People have gone ahead and have bought companies which have dropped by 90% in the US, right? And let's say you had a portfolio which dropped by, and there are people who have lost that kind of money in the recent downturn in the US, right? Where people bought the companies like Zoom and a lot of SaaS companies, and even there are companies in India also, that the new age companies. Again, all this history keeps repeating. I saw this in 2000, and I've written about it also. All these new internet companies which happened then, and I experienced this firsthand. I think one of the questions was um in terms of my own investment journey in 2000, and after I started investing, I invested in not IT companies, by the way, because by that time, I had been so much of a Warren Buffett follower that I was cautious about it. But greed takes over you. So I went and invested in some mutual funds which were completely focused on internet companies, whatever that may be, right? Because then there were no internet companies in India, but they somehow figured out, that okay, this is an internet company, and the mutual fund dropped by 70%. And there are certain companies I've written about also, like there's a company called SSI. That company dropped by 90%. And by the way, I had, it's not like I was 100% invested. Even then, whatever little bit of money I had, I managed to lose 25% of that. And that had an impact on my psyche. So I became cautious. Again, some people don't, but you can become cautious. And it took quite a bit of time for me to again understand, relearn what I had done wrong and take an action. So I think that's the important point. It all depends on you. With what is the level of loss you can handle. And most of the times, I think from experience, I can tell you that people overestimate what loss they can bear. Everybody will say I can bear a 30, 40, 50% loss. No, you cannot, right? When your portfolio drops 40%, it is scary, right? Forget about 2020. market suddenly swung back, and it wasn't I don't call it a bear market at all. uh, Fortunately, India has not faced a bear market. Bear markets are when markets drop and then they stay there for 5 6 7 years, right? It has happened in 90s. It has happened in the US also. So that point of time, I think the being conservative or being cautious means that can you sustain yourself, right? And if you can sustain yourself, then even slightly above average compounding will take care of your returns and everything. So I think to your question, Prince, uh, for me, being conservative is more about the longevity of being around in the market, of being able to invest. And if you take that particular point of view, then for me, before the returns, I would say, okay, what is the level of risk or what is the level of loss I can bear, right? If I go ahead and I invest in 5 companies 20% each, there are some people who will not bat an eyelid. They will invest 20% in a company, and if one goes to zero, they're okay with that. It's not okay for me. So usually, I very very occasionally have I allowed positions to grow more than 10 15% of my portfolio, but I usually don't, right? And for me, that's the reason. And it goes hand in hand. If you want 30 40% kind of CAGRs, and when I say CAGRs, I'm talking of a decade plus, right? Uh, Doing it in a year here or there, that's good. Social media, chest beating, but to sustain it over a long period of time requires one to be fairly aggressive and tolerant of swings in the portfolio. So that's the driver of being conservative. And again, conservative again, Prince, is very subjective term, right? What is conservative for me? But usually I cap my portfolio to around 200 so that again I can accumulate, so that I can see
Yes, very nice. We'll come to that. So, Ankit, if you have any question, or Ravi, you can ask first, then we'll move on to other speakers. Yeah.
Sure. Thanks, Prince. Hey, good evening, Rohit. Uh,
hi Ravi.
hi. Can we talk specific about some sectors? I saw you wrote something on Mrs. Bector, something on banks, financial, or FMCG if you are interested. I wanted to have your view. Say we were talking about ROC, how they are generated for the companies are
Right,
higher than your required cost. And without going into a specific name,
right,
if we bucket it something like
right,
the 3 4 MNCs which are listed in India, FMCG, the large one which are in Nifty 50, they generate 30% to 80% kind of ROE. Okay, and
correct, correct,
then but they trade at five price to sales of 10x. So lots of those return
correct,
which are expected to be generated are already baked in the price. And then you take
right,
examples of some of the Indian large cap, almost 30,000 to 1 lakh crore cap Indian FMCG, which also generate that 30 40%, but they, because of
correct,
their Indian promoter, they trades at 20 30% kind of discount. And how
right,
you
right,
how you do you find them as a, because there was one time when all these companies were considered to be a very good investment because the longevity of the business, the
right,
longevity of
right,
the
right,
business, you even
correct,
today you
correct,
can say they will stay for 20 30 years or even longer. But is it
correct, correct,
advisable
correct,
according to you for an investor who wants to generate not a very high return but something about 13 14 15% kind of return to be part of these companies where the growth rate is
right,
expected of 8 10%? uh, I can keep on
correct,
adding few data points because lots of these companies parent you will find that you're trading at 30 40 50% kind of discount multiples which trades in India. How you see, because one reason why I
right,
feel they trade at certain kind of valuation is because of the limited float available in the country. So how you see all these
correct,
data
correct,
points, because you are analyzing FMCG, how you see all
right,
these data points without going into any specific name, if we
right,
3 4 FMCG and 3 4 into the domestic large one FMCG, whether you would like to put your money
right,
now or what kind of level in
right,
terms of price earning or dividend yield you will look forward if you want
right,
to
right,
invest it.
right, right, right.
What's your view?
No, it's a very good question. Yeah, no, no, it's a very good question. Again, I think for those who are just joining in, again, we'll put a few standard disclaimers, right? Uh, I think you mentioned a name, Vector Foods. It's not part of our advisory, but I personally hold a very small position just to track it. Again, not an investment advice for anyone, right? Because I could change my mind on Monday morning, and there is no way that gets communicated out. So that's point number one, right? I may at any point of time, if a name comes up, I will, if I explicitly share that I hold it, I will let everyone know. But if I don't talk about it, then you can assume that I don't hold it. Again, at the end of every conversation, I think it will be all about saying whether I would not advise on specific names, but we'll talk about general this thing. So, but let's now let's put that aside. Uh, FMCG as a sector, I would say, um, is one of the first sectors I kind of got interested in. And why? Why is that? Because I started my career with Asian Paints, right? I've written about it on my blog, but that's where I started. I was a sales manager over there. So I saw the sector very closely. By the way, I passed out, I did my MBA in marketing. So the likes of Unilever, and that time it used to be called HLL and PNG and Asian Paints and things of that sort, right? And Reckitt Benckiser, which is not listed now in listed in India. I worked with those companies, so that was the point at which I started, and I saw how sales and marketing and how brands and all of that work. So again, a sector where I started, and I actually worked at the ground level. So that's point number one. Again, early 2000s, these companies used to not sell at such crazy valuations. Marico was available. I know, almost impossible to imagine. Marico was selling at 5 times P, or maybe some 15 times. I forget, maybe something like 10 times P or something. Asian Paints 15 times P, right? So, uh, and I've written about this. What has happened in the last 15 to 20 years is that as more and more people got into the markets, these companies were obvious candidates, right? They were so-called compounders, or they were so-called very steady growth companies. They were almost, if you look at their numbers, they almost feel like a fixed deposit, right? Like a fixed deposit account growing at 15%, right? Like you start plotting the earnings trajectory. Forget about the stock. If you just plot about their earnings trajectory, just keeps going in a straight line up. So that's point number one, right? Very easy to look at. Anybody who is starting off in the market can look at that particular company and say, okay, paints consumption will keep going up. You can actually do a regression, and you can say it will go up by so much. So that happened, right? Very easy to analyze. Which is why a lot of investors got in. So that's point number one. Point number two, and this is something very important we all of us have to keep in mind, is that up to 2010, maybe 9, 10-ish, their valuations were in a certain range. For most of these companies, whether you talk of Asian Paints, Unilever, Procter and Gamble, consumer companies like Marico, they used to remain in a certain range. I remember it used to be in that 20 to 30 kind of a range. Since then, they started a steady march up. Now you have to think, why did that happen? And I think one of the reasons, again, that's a hypothesis. You have to think about interest rates. What has happened to interest rates globally, right? Interest rates from 2010, after the 2008-9 crisis, have been on a trend down. And what happens when interest rates go down? All assets start. Look at what happened to bonds, right? Every time an interest rate drops, bond prices go up, right? So that connects to the first point I made, right? These companies had almost bond kind of uh, uh, earnings, in terms of their consistency, right? Not in terms of their level. Consistency like bonds, right? So when interest rates drop, what happens to bonds, right? Their prices go up. So what happened to consumer companies, right? Their valuations went up, right? Because you could project earnings out, and you can say, you know what, a bond at 7% interest rate, like a GSEC or something, I can price it at so much. This company, it can grow its earning at 13%, right? And I can almost think of it like 20 years, aram se they will grow, right? So I will bid that up, and that tide has lifted all the boats in the sector. Now you can say there's a differential in the valuation between, let's say, a Unilever versus a a Marico versus, let's say, a Vector Foods or something, but that's a little bit of an intra-sector kind of a difference. But that has consistently happened, right? So that has been a big tailwind in the last 10 to 12 years. You have to think about what will happen in the next 10 years. I know it's a tough one to do, but again, this is just my hypothesis. I think interest rates, if they remain at, if they are not suppressed the way they are now, then and if they remain at current levels globally, it does matter, right? In the whatever happens in the US and the developed countries does matter in India also. If they remain at higher levels, then the basic math of investing says that such high levels cannot be sustained. So that becomes a problem, right? That becomes a headwind. So let's say a company like an Asian Paints, or maybe Unilever, which if you really look at their numbers, a lot of their returns, I don't have the numbers in front of me, but a lot of their numbers have come through re-rating of their multiples. If that does not happen, what is the return can you expect? Even if you just extrapolate the numbers, and let's say you assume that the PE of 80 will remain a PE of 80, is 10 to 12% good enough? And then you have to always think of opportunity cost. Is it worth putting 12% and monitoring a company, or just going ahead and investing in the index, right? Because the index will give you the same thing, right? So then why bother with the companies? That's point number one. Point number two also is that, let's say if the valuations start dipping down, and by the way, that has happened. The time from 2000 to almost 2008 or 9 was when Unilever or a Marico or all of these, their earnings went up, but their multiples went nowhere. In some cases, their multiples even went down. So if that happens, if you put both these two things together, I'm not a very big fan of going into these companies where, again, this word I will use ex ante, which is basically before the fact. The odds don't appear to be in your favor. Again, it's a very sectoral level kind of a viewpoint. It does not mean that you cannot find pockets of companies, but I think the underlying point is that if something is obvious to everyone, then why should you get paid more, right? So I think that's the point, Ravindra, that if something is obvious to everybody and it's also priced in, then maybe the risk reward is not good enough. Right. So I know it's a very roundabout way, but what I was trying to do is to explain the thought process of, I think in all my answers, I'll try to explain how I'm thinking, and maybe how you can use the same points to think for yourself, right? Rather than telling you go in Unilever and A, B, and C will happen, or look at Procter and Gamble and A, B, and C. You have to think about these variables, and maybe that will help also you to arrive at a decision. But that's how I would think. I know I've stayed away from consumer companies since 2000, and I could have done well if I'd stayed around, but I've stayed away from them because of their very high valuations. So
All right.
Sure.
So
just
we
And,
quickly, Ravi, any
and
follow-up question, or shall we move on to next speakers?
just one thing I'll dwell on. Just one input on FMCG, and then one question on, if I can take on banking side, because I guess Ankit was able to extend
yeah,
to banks. Just a data point for the audience, like the re-rating which happened in the FMCG. If you track their 5 years, 10-year data points, India and their ROE somewhere after 2014-15 time. So the ROE was 20-30%, it moved to 30-40%, and there was a case of similar kind of return generated from the companies in the Southeast Asian countries where the ROE was increasing. And more importantly, what these FMCG did was from 2017 2021, they increased their payout ratio, which used to be 50-60%, and moved to 80-100%. So I don't know
correct,
what
correct,
next could be the trigger for these FMCG companies, but historically these were the reasons.
correct.
Coming on the
Because they
bank
cannot
side,
reinvest that much capital, right?
yeah, because everything is outsourced, they squeeze. Actually, I have one view on FMCG companies. Since you have worked there, let me ask one question. I sometimes feel these FMCG companies, they squeeze so much on their channel in terms of keeping their ROE higher, in terms of keeping their inventory and receivables so low,
Profits.
that India is
Oh
not
yeah,
able to, India should be able to grow. If we are growing at 8-10% at $2,000 per capita, how we can give, how the
right.
society can prosper? They should have better liberal kind of inventory and working capital cycle, data cycle, the sales, which is volume wise growing 4-5%, it can grow at 8-10%. But because these
Right,
are, they have to show ROE to investors, they squeeze working capital so much. We are so
right.
happy reporting that our invested companies negative working capital, but it squeeze in terms of their volume growth.
I no, I Ravindra, I would actually disagree with that. I mean, I've seen it close firsthand. I was giving the same example, right? Paints, and I've had friends who have worked in other consumer companies. So in paints itself, right? And again, this is dated, but I saw the dynamics then, and it has not really changed now. I was with Asian Paints, and I used to see other smaller companies and local companies. The growth for any of these companies was not higher. It was like a drug. The first time, a company came in and told the dealers, I will give you 90 days credit, and I know you can keep. Usually in the channel, it's about credit, right? Inventory is usually no dealer would want to hold inventory more than what they need. So depending on how quickly the company can supply and all that, dealers maintain a certain level of inventory, and you can insist on that. But outside of that, it's mostly about credit. So you give a 90-day credit, 120 days credit, it works like a drug for a short period of time. See, as a consumer, if I go to a store, I don't care what credit the dealer is getting, right? It comes down to a brand pull and a bunch of other things. So what happens is giving extra credit does no long term benefit for a company. It actually spoils the discipline. See, once you like my bosses in Asian Paints used to tell me anybody can sell. It's all about collecting the money. And we used to see all the smaller companies, like Hindustan Lever. The moment the truck leaves from their warehouse, the check used to get encashed. No questions asked. That's it. You ordered, you have to pay for it. And they've always maintained that credit discipline. So it's a matter of maintaining the discipline in the channel. It's less about, if I give a 7-8 days of extra credit, what's the big deal? But no, the moment you go down that path, it's a slippery slope. So on that point, I agree that, I disagree that, you have to maintain credit discipline. Where I think I agree with you is that a lot of times what companies have done is they try to squeeze margin in all possible ways, and the worst way to do it is to try to, I would quote unquote, fool the customer. And I don't know how much they do that now, but I'm talking a little bit dated. How they will do it, again, let's say they used to give you a 30 gram a packet, right, of something, right? Let's say chocolate or biscuit or something. Tomorrow it will become 27 grams. Today they used to put X amount of whatever cocoa or this or that. Tomorrow they will drop it a little bit, and they will keep doing this to squeeze the margins, right? Some of the products we know, right, over time they keep playing with the formulation, playing with the quality, and they will do it at a little over 5, 7, 8, 9 years. What you used to get then and what you get now, just to maintain the price points and their margin, they have screwed, they've messed up the quality. And unfortunately, this has also been done in a lot of US markets and global markets. And if you see what is happening across, which is very important, what is happening globally is store brands are becoming very strong. Why? Because those guys give a better quality and at a lower price, and they don't have to spend as much on marketing. They don't have to spend as much on shelf space, like below the line and above the line kind of marketing, and they pass on all the benefits to the customer. So a lot of store brands have started doing well, and my guess is that will happen in India also, right? Because store brands, they don't have to advertise. They can actually give you a slightly better quality, and consumers are not fools. You can fool them a little while, but you cannot fool them forever. So I think that's a big risk for all these companies. If they keep playing around with the quality and they don't keep it up to maintain their margins and their ROE, and they keep milking the cow, one of the days, it will start biting them back. So, partly I think I agree with your point, but on credit discipline, they can maintain it. They should maintain it.
I guess,
Right.
Prince, we can go to other people and then
Yeah,
I
yeah.
will come back with banks.
Right, right. Yeah, Aksh Bera, you can quickly unmute and ask your question.
Hi, sir. Thank you for the opportunity. Good evening, sir. Sir, I have
Good evening. Hi.
question about the you touch upon the data. So there's a company called Lux Industries. They have increasing debtors and they are funding their growth by the short-term debt. So how you
Right.
will deal about this situation?
Again, I've not looked at that company very closely, Aksh, but
Yeah.
Broadly, again, my personal experience has been that if you get, and doesn't matter whether it is this company or any other company, and again, my personal example, when I've worked also, I've seen the same thing. uh, Debtors, there is no like a golden number which says, oh, if debtors go above X, it's a dangerous situation. But it's a trend, and it's also that line, right? If it happens temporarily, it is okay, but you have to start thinking about what is the trend. And again, I don't have the numbers in front of me, but look at the industry averages, right? Let's say, on average, if the industry, the credit period is, let's say, 60 days, and this company is giving 90 days, are they holding on 90 days? And sometimes the debtors is a function of the company's strength in the marketplace. What Again, this is Lux is one of the undergarment manufacturers, right? If I'm not mistaken.
Yeah, yeah, yeah.
Correct. So compare it with what Page can do. Now you cannot say, oh, Page gives. Again, I don't have the numbers in front of me,
So
but
I
I'm
have the
sure.
numbers.
Yeah. So
Uh,
if
so
Page, yeah, go ahead.
so Page gives a credit period of 15 days, and these guys are giving a
Correct.
credit period of 120 days.
Correct. So first of all, you cannot compare them, because what a Page can give. Page has a credit period in FMCG industry is a strength of that company's. It's a how much power they have in the marketplace, power or competitive advantage. A company with very strong brands. See, every business, every distributor, dealer would want the maximum amount of credit period. They will every time a sales guy walks in, the first thing which will come up is, give me more credit. Because why would he or she wants, why would that businessman want to add his money into the working capital? So they will pressurize a company. What a company ends up giving is a function of how much power their business or their brand has in the marketplace. Now, what a lot of time what will happen is, the company with the lesser power in the market will give slightly higher credit days to be able to have a foot in that particular this thing, right? Because otherwise the dealer will say, or the retailer will say, why should I keep your brand, right? I'll keep Page if you're giving the same credit days, because I can turn the inventory much faster. I can pull the customer in, I can sell. So again, the other guy has to give more credit, but the question is how much more. Again, no thumb rules, but if you see that the average is much more, you have to start thinking about how are they getting that particular sales. uh, Usually in fast moving consumer goods, these debts will not go bad, right? Because these are, you can always sell some of these products. It's not like you'll get stuck with the inventory. But what is the trend over there, right? Is it increasing? Is it flat? Is it going down? If it starts going down, it means that the initial seeding has worked, and now the brand is picking up strength, and it will slowly, they'll be able to control it. If it starts going up, then what that means is that the company is just trying to buy the business, right? They're trying to, again, no specific comments on Lux, because I've never tracked the company, or I've not followed it. But I would get I usually would get concerned if the debtors start increasing and start going in the wrong direction. So I think, it will definitely be higher than the market leader, but the question is, what is the trend you need to look at? uh, you fund Whether you fund it with short-term debt or not, that's just a funding decision. It doesn't matter. It's working capital, right? So obviously you can fund it with short-term debt. So that's not the risk, right? The issue is, what's the trajectory, and is it sustainable? Because the day they pull it back, sales will start getting impacted, right?
Right, sir. So, Gaurav, you can unmute and ask.
Thanks, Prince, for hosting this, and thanks, Rohit, for sharing your insights. Um, Rohit, I have been following you for quite a long time and really appreciate the work and the
Thanks.
knowledge that you've shared. Uh, my question is more regarding, I think you talked about the time horizon, like some people have close to 5 years of time horizon, some people have close to 10 years of time horizon. But how do you place sector rotation in this? Because if I quote, like, for example, 2020, many people, because of expectations around banking, moved out of that. Similarly, like
Hmm.
people currently have
Right, right.
talked about same in IT. But you know that for some of these things, there are some long-term secular trends, and if you remain
Right,
invested,
right.
maybe you will. So how do you try to manage that with some new opportunities which may be coming? Yeah.
Correct. So I think it comes to the same point, right? Like what is your time horizon? So that's a good point you brought up, right? And that cut also ties into the second point around cyclicality, right? So the first thing which you have to think is, I mean, again, these are just broad ways to think about it, right? Again, it's not a formula which you can plug in and some answer will pop out.
Yes,
So
yes,
let's
yes.
compare two things, right? Let's look at IT. Let's look at banking, which you just mentioned, and just for contrast and compare, let's take up steel, right, as an example. Now, let's say if your approach or your thought process or your way of investing is you like to buy a company on average, right? I mean, you can get opportunities, you can move in and out and all that, but your natural tendency is I will buy a company and I would like to hold it for 5, 10, something like that. When you start thinking in terms of that, your tendency will be, what would I avoid? First thing you will avoid is a steel company, right? Not that you cannot make money, right? there are
Hmm.
there are enough investors who are in the steel sector, and by the way, there is no sector which is good or bad. I think that's something, again, where people tend to talk past each other because they have different time horizons, right? If you are, let's say, sugar gets spoken as a bad sector, steel gets, there's nothing good or bad, it's all your time horizon. If you think in terms of a year or two, and you are comfortable with cyclicals, you can make a very good amount of money through steel, and people do that, right? I know a few good investors and friends who do exceptionally well there, right? But let's say your natural tendency is to buy a business and hold it for a long time. You should not be then thinking about investing in steel, right? uh, let's say you come to the IT sector. IT sector, again, now you have to think on the second point which I brought up, cyclicality. There was a phase in the IT sector where it was on a secular growth trend, right? 2000 to 2010ish was the time period. It has now become more nuanced, right? That entire offshoring model which played out in that 2000 to 2000 era, that that base model has kind of played out, right? Like, you will not get 20% growth through offshoring. You cannot go to a company in the US or Europe and say, I will offshore for you and you will save 10% of your cost. I mean, everybody and their uncle knows that. So now you have to be a little more nuanced, right? Maybe there is a company which is doing exceptional work in the in the ERD, or some sort of product management space or something, and you play some sub theme in that, right? So if your thought process is, I usually prefer to hold a company for the long run, then you would try to move in that area, and you would hold, rather than a sector, you would hold that particular company. Let's say same thing in financials. Your thought process is, I usually prefer to have companies which I can pick and hold, and I can stay there, and in spite of these small fluctuations, I can live with it. So maybe you will pick up one of these big banks, right? Or you will pick up a good private sector bank, or maybe a good NBFC, where you can invest in that company at a reasonable valuation. And again, not an investment advice, I don't hold it also, but let's say as an example, right, to make it up, let's say you will hold a Cholamandalam Finance or something like that, right? Company is doing well, can grow at a decent rate. I can hold it for 5 years, forget about sector rotation. There's another investor who is far more aggressive, who is far more, active, has a shorter, on average, whether he or she knows it or not, has a shorter time period, likes to churn the portfolio. We'll look at the same set of companies and we'll take very different set of decisions. We'll very actively move out of a sector, when that sector has peaked. It'll move into another sector where a sector is, doing well. So that's where your sector rotation will come, right? Extreme case of sector rotation is where cyclicals, right? You'll buy a steel company at near, or closer to the bottom of the cycle, and you will exit when the bottom of the cycle is done. So you'll do very well. You'll find some other sector where you can play the cycle. A guy who is going to hold for 5 years, the last thing he or she should do is go into a steel company or a sugar company, right? And I've done that mistake, by the way. I read all of these things and I went and bought a cyclical company. That's the worst thing you can do if your time horizon is 5 years. So that's where your sector rotation comes in, right? Are you ready to jump in and jump out, right? Or let's say if you really want to hold for a long run, then avoid some of these sectors in the first place, right? Because you don't want to jump in and out. So hopefully this answers your question.
Yeah, thanks, Rohit, for that. Yeah.
So Rohit, I have one question in between. Like when the addressable market is large, so
Right.
basket approach is a better way to go about it, or we should be like hunting for a company which can do well. So what should be an ideal approach in such circumstances?
Right.
I mean,
Right. Again, I think, I know I tend to give a more uh, a gray answer than, coming straight, okay, do this, right? But usually, a broader way of thinking usually helps. It comes down to, first, it will come down to the level of analysis which you do in a particular sector. Let's say you have been following a sector for a couple of years and you have a very good understanding of all the companies in that space. Maybe then you can pick one or two companies and bet on that, right? Why? Because and I know that you've interviewed some of the speakers, Prince, and there are people who are exceptionally good, let's say in pharma, or exceptionally good in, and it's not need not even be a large a theme or a tailwind. It can even be a sector which is cyclical, right? Like you're an expert on steel, right? Coming to the same example, or sugar. You can actually bet hard on one or two companies and you can make exceptionally good returns. Same thing for this. But let's say your interest in that sector or your knowledge in that sector is not so deep and wide, right? It's not like you've been following that sector for 10 or 12 or 15 years, right? Or something like that, 10 years, right? Then I would say take a basket approach. I usually take more of a basket approach because, good or bad, I don't think I'm so smart that I can find that one company. So if I think that sector is going to do well, I usually will take two or three companies. I have that tendency, so that, okay, if the overall, again, it will not be the highest possible return, but I will do reasonably okay in that sense. So that's my tendency. But it comes down to, as an individual, you have to be honest with yourself. What is your level of understanding? uh, and again, then kind of go down from there. So I think, that's the way to do it. If you've been following that sector for quite some time, couple of years, you understand that sector very well, then, go ahead and take one or two positions in that. But if not, then take a basket approach. I think that's usually the way I would approach it, Prince.
right, fair enough. So we have another speaker, Jay Shankar. Yeah, you can quickly unmute and ask your question. So in between, Rohit, we are good on
Thank
time
you.
because already
Thank you.
90.
No, no, yeah, we can continue. I think that's fine.
Rohit, couple of questions. I know you are determining your cash position based on, the opportunities, right? I'm going to give you, because the way by which my mind works is that, right? I don't do this in India. I do that rather in US.
Right.
So first and foremost question in your mind is that, uh, uh, it's very hard to beat a S&P 500 for a
Right.
retail investor, right?
Right.
So do you think really long oriented, if you have a 10-year time frame, and
Hmm.
if you pick stocks here in US, will that work? Because I don't have any fees for myself, right, as an individual. Do you think
Right.
that
Right.
will
Right.
work? What's your thought? That's my first question. The
Yeah.
second
Uh,
question in my mind is that, can I go for the second question, or
yeah.
you,
Yeah.
you
Go
want?
ahead. Go ahead. Go ahead. No, no,
The
you can.
second
Yeah.
question in my mind is that it's more around risk in my perspective. The
Hmm.
reason I was thinking about this thought process is that, right, I've got in my universe about 180 companies, right, spread
Right. Right.
across the 50 sub industries. So my thought process on allocation is that, right, I look at about how many of these industries are in a buy zone. So if you go back to the shallow bear market that you referred in, 2020, or even in 08, 09, right, many of these would have come in buy, right? But
Right.
right now they are not, or back in early this year, right? It's only about 25% which may be in buy. So I was thinking in
Right.
terms of, hey, is your allocation really related to that? Because you don't have opportunity. I'm not saying a macro call because I don't have
Right. Right.
opportunity, right? So I want to hear your thoughts on these two.
Right. So, in the second question, what do you mean? I mean, when you say it is in buy, but I didn't quite
Oh,
get
basically,
that.
what I was saying is that I wanted to invest in good companies, but they were all priced out early this year, right?
Okay.
So if you take a December 2021 or January 2022,
they were
Right.
not attractively valued in the sense that I don't have a
Right. Right.
margin of
Right.
safety, right?
Right. Right.
None of those, I have my own model. None of that had a,
Right. Right.
but
Right. Right.
the problem in that juncture for me is that, right, personally,
Right.
I didn't have
Right.
the courage to pull out to go as low as 20% equity. Hindsight, that would
Right.
have been the right decision, but I didn't do.
Correct.
Where
Correct.
that helps is that, right now, if I do a S&P, right, then I go and do a belief-based investing, right?
Right.
Versus if I do that, I'm not doing a belief-based investing. I know what I am buying, right? And a
Right.
belief-based investing can work or cannot work. If I stick to another 20 years, that could really be it with very less effort for
Right.
me.
Right.
I agree.
Right.
I do enjoy it. That's where I was trying to think about,
Correct.
I don't agree about, macro, how do you forecast? Rather, you pick your universe. Within the universe, you see about what's the opportunity and allocate based on the opportunity. Don't worry
Right.
about anything else, right? Because you don't know
Right.
anything
Right. Right.
else.
Right.
Okay, so your
I
thoughts?
yeah, yeah, and very good question. And I think a lot of you, the answer is going to be paradoxical to the group we are talking about, right? Like everybody on this call, including myself, we are active investors, right? Because if we were all indexing, why would uh, on a Saturday evening, why would you be listening to some guy on Twitter Spaces, right? You would be going out and partying, right? So so that kind of shows it. But the reason why it's paradoxical is because what I'm going to tell you is completely the opposite. So this is, and I've written about it, and that comes to another point: return on time invested. So I'll give you a very personal view on it. I have kids, and they are not even remotely interested in investing. And you know what? I will not even ask them to get interested in investing, right? Because what I have already kind of thought through, and if they want to take up and actively invest in stocks, good for them, right? But I have already kind of made up my mind that my first advice to them and to most of the people I meet is go ahead and just set up a sensible asset allocation approach, right? Work with an advisor or whoever can advise you, and index, right? So
Mm-hmm.
point number one is you should just go ahead and index. And why is that? Because I think to your point, it's already happening in the US, or it has already happened in the US, and it will increasingly happen in India, is that the delta returns which you get over and above indexing are going to keep coming down. I mean, that's the nature of things, right? Competition is increasing. And when I say, what I mean by that is, don't go by a particular year, right? Oh, I made X percentage, and I'm not saying directing it to you specifically, I'm speaking in general terms. I
Mm-hmm.
made X percent in this year, or I made Y percent in that year. No, that's not the metric. What has been the like a 5, 10, 15 year return? For majority of the professional investors, there is enough track record in the US. In India, that is slowly developing. Those returns are slowly coming down. So as an individual investor, each one of us have to think, is it worth is that delta return worth the time I'm investing in? And the delta return is not, we'll just make a number up, 18% per annum, right? It's not
Mm-hmm.
18%, it is just 2% or maybe 3%, because 15% you can get without doing anything, right? Which means
Correct.
you can either go to the index, or you can pick up some mutual funds, some decent mutual funds, SIP, and then just carry on with your life, right? So you're making that 3%. So is it worth the time? Which comes to the second point. All of us do a lot of things out of sheer interest, out of passion, out of interest, right? I do that myself, and investing for me is that, right? I've written a blog which financially is a negative ROI, but I've done it because I just like to do that. So if you like to do that, then forget about the return part of it. You just enjoy doing it, right? And just do. So the way I think is that you should. When I started off, I took a lot of my money and I actually put it in mutual funds, because my
Mm.
point was, for the first 10 years, if I cannot beat a mutual fund, then I should not bother doing it in the first place. But then over time, I realized that, what, I enjoy the process and I'm doing reasonably okay. Right? I'm doing
Mm.
better than mutual funds. And then I became more and more of an active investor. But if you're starting off, you should hedge. I would suggest hedging the bets, right? Put some money in indexing, right? Because beating an index over the long period is not easy. So whether you are in the US, whether you are in India, over time, that is what will happen. and then maybe take a certain percentage of money and then start actively investing. And that percentage can vary depending on what you can find or what you cannot find. But the bar set by an S&P 500, and I think you would have seen that in the US, a lot of people did exceptionally well up to 2020 or 2021, and by now 2022, the last 10-year performance for most of these people have now gone back to square one, or maybe they are back, they are actually underperforming S&P 500. Right, like 2021 was like the high water mark where people had beaten the index by 10%, 15%, you name it, and now it's all back to back to the starting line. So I think in that sense, I any anybody who cares to listen in my friend group, and by the way, nobody ever listens. People still end up doing whatever they have to. But if I, whoever cares to listen, if they are not actively investing because they enjoy it, my personal recommendation is always to index. And when I say not actively invest, it means you're spending a decent amount of time per per week. Decent being maybe, let's say, 10 hours plus. Because if you do lesser than that, then you might as well expand your time horizon, which comes to the first point, right, which I made. Then think of buying into companies where you can buy and you can hold it for 5-7 years. Like trying to do sector rotation, trying to go into cyclicals, and spending a few hours a week will not gel together. Then let's say you work in the technology industry, just as an example, or like I used to work in the FMCG industry. Understand that
Mm-hmm.
sector because you enjoy it, and then hopefully that sector is in a long-term tailwind and will keep growing. Buy a few companies, put it in your portfolio, and then just move on, right? So that's how I would have. So it's a function of the time which you can spend if you want to do actively invest, right? So that's
Okay.
maybe the answer to your first question. And second,
Mm-hmm.
I think being an individual investor, you are under no pressure to be invested, right? Like nobody is holding a gun to your head and saying, so if if you're not comfortable, and I think from your question, I understand you. I think you're an individual personal investor. So it's
Yes.
not this. There's do it only when it makes sense for you. I have a beginning of my career when I started investing. I didn't care about what cash levels I held or something. Only if something made sense did I put money, because there's enough runway, right? Like you can invest till the last day of your life, right? So you have a lifetime ahead of you. There will always be new opportunities coming in, right? So if you didn't invest now, and if you later in the year, the difficult part is hearing from all your friends saying I invested in this coin or that coin or this crypto and that crypto and made 10x, right? Avoiding that is far more difficult than doing sensible stuff. So if you've been able to hold yourself back from doing that, I think you won 80% of the battle. Now it's while everybody's nursing their wounds, you can actually go and you can do some sensible stuff.
Yeah, correct. The market actually throws up opportunities all the time. I agree
Oh
with you.
yeah. Yeah,
Hey,
not
let
doing, yeah, not getting greedy, and I've done that enough myself. So it's not that it's a moral argument or anything of that sort. I've done enough stupid things in my investing career, but not one of the advantages or learnings you get over a period of time is you start doing less and less of stupid stuff. That's all that happens. So you will not get into a Dogecoin or into some crazy crypto this thing, because you'd have seen that script play out in the past where all kinds of crazy stuff were happening. Or you would not get into an IPO which was selling at 1,000 times earnings, or maybe 30 times, or maybe 100 times sales, right? It's like just you've seen that story play out 20 years back, and you just want to stay away from it. And I had actually tweeted about it. The company may be really good, but you know what, you would
mm,
say, let others make that money. I'll just stay put. I'll just stay calm. I'll figure my time out. So there's no hurry, right? If you still don't feel comfortable, just create a small position. That's how I do. I just create a small position and start tracking the company. And then what,
mm,
over time, if something interesting comes up, you can scale into it. If nothing happens, then you just exit out of it. So
mm.
so at least that's how I approach it.
Hey, no,
Thank you
thank you.
so much, sir.
That's very, very wonderful. Thank you. Thanks a lot.
Thank you,
Sure.
Jay. So,
Yeah, go ahead,
Rohit,
Chris.
how easy or difficult the small cap and mid cap space is? Like, what are your checklists? And when it comes to Scuttle, but what are the main
Right.
points or questions I mean, do with the management or the people you are meeting, so as to get maximum out of them?
Right. So first of all, I think the amount of time you have to spend is more on small and mid caps, because by their very nature, their business models, mid caps, are slightly better. Their business models are more mature. Small caps, by the basic nature, the size of the company and all that, their business models are still immature. So you have to think about both the segments. And again, there's no fine line, but you have to think about both of them a little bit differently. In small caps, the opportunity could be very big, but the important thing at the time of analysis, by the way, I always prefer first to start with, and I think this comes, I think the best book to read and kind of get a good idea, and it has been written ages back, but I think the old books on investing are always there is a reason why they are classics, is Common Stocks and Common Profits by Phil Fisher. Read that book to kind of get an idea about how you can go about scuttlebutts, right? He was a US investor way back in the 50s and 60s, and uh, so scuttlebutt in a small cap will be different from that of a mid cap. So my preferred approach is first read up everything which you can. Don't go to the management and ask them basics about their business, right? Because when you're able to get in touch with the management, the idea should be you should appear to be reasonably knowledgeable about the business. Managements really do appreciate that you have done your homework completely. Have a complete list of questions prepared beforehand, and those questions should not be answerable by reading an annual report or by reading a conference call. And by the way, if you read annual reports, maybe going to the last 10 years, which is what I usually do. I usually read annual reports by alternate years. So I will pick up an annual report for any company for 2000, 2010 at least, when I'm starting my analysis. 10, 12, 14, 16, 18. Why not every year? Because I want to see what is the delta which is happening. And at each point of time, what I will do is I will read the annual report, just as an example, for 2010, and I will make a note of what the management committed at that point of time. So just as an example, right, not for new IPOs or anything, but let's say for example, I'm looking at a capital goods company or something of that sort, right? Or let's say a pharma company. The management is saying I am going to put up a capacity and I expect it to be operational. Let's say you're talking in 2012 by 2014. So I have a table where I will say, uh, the first column is, okay, what was the management commitments, what are the key variables I think are relevant to the business, and what is the management saying about those key variables, right? And what actually happened, right? So for that, you should have first read all the annual reports, read through all their past conference calls, and then I start making this note. I will say 2012, this is what the management said, and this is what happened. I do that for 10 or 12 years, and you will see a pattern emerge, right? You will see a pattern emerge, whether is the management too optimistic, too pessimistic, right? Do they overpromise and underdeliver, or they underpromise, overdeliver? How how um, uh, realistic are they about their external conditions, right? Like, do they have a good grasp of it? And when you're doing this, this is the way you would approach a small cap versus a mid cap will be different. Mid caps usually have a far more mature business model. In their case, it's more about, are they able to execute and expand. A small cap is still in a place where they are still, they have a good idea which has just gained traction, but can they scale it? So what you would try to look at in a case of a small cap is management going from a place where they are an individual promoter driven to a team of people. And again, just as a disclaimer, I own this company for both myself as my and my investors. But companies, let's say like an APL Apollo, right? Sometime back they were a small cap, but you could see the progression happening where they started expanding and they started putting additional layers in place. Same thing happened with a company which we still own, and we have owned it for the last maybe 10-15 years, Sarah, where one of the CEO and the promoter's son, who was a key kind of a a driver behind the company passed away, at a very young age, tragically. But they were able to bring in new people in. But it was a fairly small company, and at that point of time, you could see that the company had started expanding into they were bringing that that second layer in. So small company, small cap company, it's about about building a team, about expanding that particular idea. Same thing about Vector Foods, which I've written about. It's a small cap company, right? So it's more about bringing in additional professional management, expanding the bench strength, not being just promoter driven. A mid cap is more about execution. You've gone to a place where the management has already been put in place. They've tested their idea out in most of the markets they can, like at least they are, let's say they were based in the west and the south. Now they are expanding to the east and the north, right? So it's more about consistent execution. So what you're tracking in the case of small caps is more subjective inputs, if you may, right? You'll have to read a little bit in the lines and you have to see. By the time you get into mid caps, you can get into far more hard metrics, right? When you get into large caps, it can be a lot about just metrics alone. You can just say, let's say you're analyzing a bank, HDFC Bank. Okay, this is the growth number, this is the NIM, this is the NPA, this is this, and you can just put those numbers and just see how that is. So you'll have to approach all the three in a slightly different fashion, and then the scuttlebutt will be based on that. In a large cap, you may not require a scuttlebutt also in a lot of cases. Mid cap, maybe you should, maybe you should not. Small cap, very essential, because you'll have to go kind of get a feel from the channel, from the people itself. Will they be really able to scale or not? So Prince, hopefully this answers this question. I mean, this topic itself can become a 2 or a 3 hour kind of a session for me to answer, with a specific example. But
Right, right. So another question, like I heard you in your session with SOIC, like when we ask about risk arbitrage, special situations, and turnaround stories, the time invested in those studying those
right,
companies comparatively more. So, I mean, who should look for those opportunities? Because in today's era where we have a lot of noise, the names appear, pop up all the time, and
right,
people get, I mean, out of FOMO or maybe lack of whatever you can say, they
right.
fell for the narrative. So, how to approach
Yeah.
such situations? I mean,
Right. So turnaround stories, I would put it differently from special situations. I did a little bit of special situations maybe 8, 10 years back, but then over time I realized that amount of time which I had to invest to do it versus the returns I was making was not worth it. Like, and by the way, again, there are people who enjoy doing this, but for that you have to keep a track of filings and you have to read through it and all of that stuff. And very honestly, that was not my cup of tea. Now, I didn't want to get into a position where there's a pricing mismatch of a few percentage points, maybe 5, 6, 7%. And by the way, those opportunities are shrunk, but that does not mean it does not have a place. Let's say if there's a demerger which is happening, okay, that's an attractive area, right? The demerged company will be attractive, but fundamentally, I would not do a special situation to make that 8 or 10%. Maybe in my case, the special situation is part of it's like the icing on the cake. Again, uh, I'll take an example, in which we are not, in which I'm not invested, but I know of people who have spoken about it. So again, not a recommendation or any advice, because I have obviously not invested also. Let's say that the Equitas, and again, I'm going a little by memory. I think there's a reverse merger or something of that sort, right? Maybe where the parent company is going to, or the bank is going to reverse merge or something of that sort, right? So my basic idea is that if I like the idea in and on of itself, right, I would buy that particular company independent of that special situation or not. Then I would look at that idea, because then the special situation is just a delta on it, right? Like, I'll make a few extra percentage points, but I usually don't end up buying and take an advantage of, okay, that delta is why I'm doing it. I will still look at a special situation because it sometimes creates opportunities after the special situation has happened. So let's say a demerger happens, and the smaller company which gets listed will face a lot of pricing pressure as soon as it gets listed. And the only reason why I would enter into that particular position is not because I want to make that 10% when the pricing pressure comes off or that selling pressure comes off. I I inherently like that particular company or that de-merged business. So I will buy because I anyway wanted to buy it, right? And I wanted to hold it for, let's say, X number of periods or something. And by the way, you know what? The market is giving me an additional 10 or 15% discount. But I'm not buying it because of that discount. I wanted to buy it anyway. It's just that I'm getting an extra bargain, right, out of it. So that's how I approach it. Does not mean, but the reason why I stopped kind of doing it is because too much of time and effort. And again, same thing, right? All our times are limited, right? So we have to always think, where will I get the from an investing standpoint, where will I get the biggest bang for my buck? So for me, special situations was not that. But if you do this for a living, or if you invest actively and you spend 40-50 hours a week, then you can get that extra uh, delta or an alpha by doing this. But I usually don't do it, not because I don't like it, but based on the time which you have to spend on it. That's the only reason.
Right, right. So, Kanan, you can unmute and quickly ask your question.
Hi, Prince Bhai. Thanks for hosting this space. Hi, Rohit sir. Have been listening to you
Hello.
ever since the start. So, really like the
Thanks.
conversation. Yeah. Am I audible?
Yeah, go ahead.
Okay, great, great. Sir, so since we are talking about value investing over here, I just wanted to understand what's your view on, and what's your view on SME investing if someone has a portfolio of 1 CR plus, because then it can be diversified one, because the companies I believe over there are reasonably available at a bargain. Like
Right,
if
right,
we
right,
compare peer to peer, of course there might be some capacity expansion bandwidths also. Bandwidth,
right,
as in they might not be able to expand, and that's why the PE that they get is justified.
right.
Otherwise,
SME
also.
is in small and medium, right? The
Right, right.
SME
The
exchange
SME
on
BSE
BSE.
listing. Yeah, yeah, yeah.
Correct,
Exactly.
correct.
So, what are
Uh,
the critical areas that one should look at? And, like it's micro cap investing only, because the companies are typically
correct,
from 80, not even 80, but 50 to 200 crore market cap companies that
correct.
get listed over there. So, what's your view, and what are the critical areas that one should look at while
Right,
investing
right,
in SME companies?
right. So I think the SME space, uh, it is one of those spaces where the rewards can be, I mean, phenomenal will also be an understatement, right? It can be life changing, if you may, right? And again, I'll again I'll again, this is I'm going to obviously uh, uh, put a caveat and all of that in my subsequent response to it. It is the closest you can get to venture capital investing in a public space. Like, think of SME
Mhm.
investing like venture investing. And that term
Absolutely.
itself will help you in terms of thinking about it. What does venture investing means, right? It is a bet on the entrepreneur, and it is not a bet on the business, right? In this case, it is not entirely angel, right? Because there is a business over here, right? That's why it's listed, right? But otherwise it would not. So it's like something beyond venture, but it is close to that, right? It is an area where a concept has been a concept or a business model. I would not call it a business model, because obviously these companies are not doing something which is completely new in that sense. But it is a business which has kind of it just started walking, right? It's not even, or maybe crawling, right? It's not even walking or running in that sense. So it's in a very nascent stage. So in such a space, I think there was a question around scuttlebutt, right? And I think you should not be venturing in this space if you're not going to do scuttlebutt, right? If Unless and until the annual reports, the first of all, you will not find any articles or anything about it. Like, no broker will talk about it. Again, not to knock anything down, but the only time you will find an analysis of the company would be when there is an IPO, and a banker or somebody is writing about it. And don't expect them to be telling you about the negatives about the business, right? They will
Yeah,
always tell you about the all the positives, right? So that's point number
right.
one. You have to do deep scuttlebutt. Point number two, there is enough fraud in that space. is, I don't know if you were invested during the period of 2017, but 2017 is when a lot of companies got listed in that space,
Hmm.
and a lot of companies have just disappeared. They came
Right.
in, right? I mean, I will not take names or anything of that sort, but my God, the amount of fraud which was there in that space is mind-boggling, right? Companies came up, listed, pumped their stock, dumped it, and they are now gone. And nothing happened, by the way, after that. So unfortunately, that is also the other scenario, right? So you have to be very careful about that, which is why it come back to the same point. A lot of, so forget about the amount of the portfolio which you mentioned. It doesn't matter what the amount is, and I have a few very good friends who invest in that space. Point number one, deep amount of scuttlebutt. You have to attack or attack this particular analysis or idea from multiple angles. You have to do scuttlebutt. You have to go into the broader industry and find out about the promoter, the company, the management. You name it, right?
Right.
Second, you have to be diversified enough, right? You should not go ahead and do any concentrated investing in this place. And the most important, you'll have to be very patient, right? Because there will be days where the stock may not even trade, right? Or it may trade a few shares, which is where it comes back to the original point of venture investing. What do venture investors do, right? They will buy something and then they will wait for 5, 7, 8, 10 years. But you could have 100x or 1000x also. One company will do that, but that would be the company which will completely make your portfolio. So it's
Right.
a very specialized form of investing, right? And uh, usually 99% of the people, I would tell them, don't bother about it if you're not going to put the time and effort and have that extreme amount of patience. Like you'll have to sit for years where your friends are talking about pharma sector, IT sector, steel sector, where you've invested in this company which nobody has ever heard of, and you'll have to wait for 5 years before you get a payout. So
Right.
so it's a very different space.
And
But
in
yeah, it can
fact,
be
even if
very,
we
very profitable.
Yes, and in fact, even if we talk about the liquidity, that's very, very low in this
Oh yeah,
space.
yeah,
And then off the record, since we're talking over here, then there are companies who primarily list with the objective of converting their money from one source to another. Like, of course,
correct.
I'm not saying in it as many words, but we do understand that. So, as you correctly
Yep.
said, sir, the effort required in scuttlebutt is gonna be, very
Right.
high over here
Yep.
because
Yep.
you don't
Yep.
know what the profile of the promoter is, what is in his mind. You
No.
just can't figure it out.
I think a very, very useful thumb rule in investing is this, very simple rule, right? I've always believed in these rules and they always help, right? There is no easy or free money in the market. As
Right.
simple as that, right? Majority of the times, I think most of us, me included, we forget that simple principle, and we end up losing money. Like if something appears to be easy, then there's a catch behind it, right? So if you're going to make more returns, whether it's a crypto, venture capital, mid cap, small caps, you have to think, okay, you can make a reasonable return by investing in the index. So
Right.
if you're going to make a 30% CAGR, why should it be easy, right? There has to be what
Something
what
into
I
it.
think. Yeah, most of us kind of, we everybody has, you active investing is almost an unreasonable faith in your own abilities, right? You have to believe in yourself. Otherwise, why will you go and buy companies directly, right? You would index, right? So you have to have
Right.
that very optimistic appraisal of yourself. Now, if you think, I can just make 30% or 40% CAGR and maybe even more when you're doing it in SME, and it will be
Hmm.
easy, it will not be, right? And very few people are
Right.
so exceptionally good that they will make it, right? I mean, so that's the thing, right? There will be risk, there will be hidden risk, and the lower you go down in the curve, you will do it. I mean, honestly, at a personal level, I bought a few companies here or there in the SME space, and I actually, when 2017, when a lot of these companies came out, I just downloaded all the data and I started looking through that very quickly in 17. I still remember that. And 99% of the companies, I just rejected them in a minute or two, because for some or the other reason they were so small, not making money. And even three or four which I managed to track, after a couple of times, a couple of months or a year, one or two turned out to be a fraud. And some
Hmm.
of them, just before the IPO, again, I will not, definitely not go into names here, but
Yes, yes.
one classic way what I saw which happens in this space is you pull up the IPO document, and it is a perfect upward line of last 4 years of number. 20 crores top line, 40 crores top line, 80 crores top line, 120 crores, everything in a nice upward smooth. They list after 6 months, boom, the sales collapse.
That's
And
great.
that's it. The stock is gone. The stock is gone, and it's completely disappears. So I have to be very careful about it, right?
So
In this
that
space.
that's great, sir. I'll just add two quick points over here. So one, with very little experience that I have in markets, one thing that someone in this space can look at is, the merchant banker who's behind this IPO. So there are certain merchant bankers who are behind such kind of IPOs. So maybe it can be like simply said कि इनसे दूर बच के रहना चाहिए हमें. One is
Yeah,
that,
yeah.
or and then there are someones who are underwriting this issue on a huge capital base, and they are doing good consistently. So that can be
Hmm.
also looked at. Again, not taking
Right.
names, otherwise it will constitute solicitation. That is
Correct,
there.
correct.
And sir, in fact, how I look at small cap investing or micro cap investing is like if I have saved enough, or if I'm saving enough, doing enough SIPs for my critical goals like buying a house or retirement, buying a car, kids' education.
Right, right, right.
After that, whatever money with I am left with, then I can do that venture capital kind of thing with markets.
Correct, correct,
So
correct, correct.
that's how I look at these investing
Absolutely.
spaces.
Right. Again,
Thank
just I've written on IPOs in my own blog also. Again, a simple thumb rule, right? If you are selling something, why will you sell it cheap, right? I think just I think for all the participants, just think of it that way, right? I know some IPOs will come out and they will do well and all that. That is again, but the base rate, right? Like the average, they will not do well. If you have and I know there are people who have the skills who will look through 20 IPOs and will find those one or two which will do well. But you know what? Let the company get listed, right? Let the froth go away. And then, if you like the business and the business model, then, you can always get a good price. So there will always be a few DMarts, but the average experience is not of a DMart, right? Most of the IPOs don't do that.
Right. Thanks,
Great,
Kanan.
great insight, sir.
So, Ankit, you had another question, so you can quickly ask. Rohit sir, I need to ask you because it's already 2 hours. How good we are on time? I have all the time. It's up to you.
We can do another 30 minutes. I think it will get late. I think it's getting what, 10. So, again, for you also, right?
So we are
So,
good.
yeah,
Like
another half an hour
listening,
and then we can go.
listening to you is like we can listen for another hour also, but it's up to you. Ankit, quickly you can ask,
Uh,
sir.
Yeah, so Rohit,
yeah.
it's just like a Saturday evening party for us, so we can go on as long as you are
Yeah.
ready.
I,
So
yeah,
my
I don't want to bore everybody now completely. So we'll do another 30 minutes and then,
yeah,
that's
sure,
enough.
sure, sure. So my next question is a follow-up on you mentioned about Sarah, and you mentioned that you've been holding on to Sarah for last 15 years. So
Uh-huh.
this is an important question, not just because of I'm not going to talk about the business because we all know that what kind of a great business it has been all over the years.
Right, right,
But
right,
my question is more from a portfolio management perspective. So
right.
if you look at the share price of Saira, so from 2015 it has just doubled in last 7 years.
Mm-hmm. Mm-hmm.
And generally there is a saying like in the market that you have uh, ideas are limited, but capital is limited and ideas are unlimited. So
Correct, correct.
that is how, and I'm 100% sure that there would be many companies in your portfolio which would have done much better in terms of price appreciation compared to
Correct,
Sarah.
correct, correct, correct,
So how
correct.
do you look at this situation in your portfolio? As in, how do you manage that?
Right. And I think this partly comes down to and that's why I kind of started with that monologue around time and what kind of an investor you are and what kind of effort you can put in and all that, right? So, and again, all of us change over time in terms of how we look at companies. So, uh, when I originally invested in Sarah, and in that particular phase, my approach was more in terms of I will buy a company and if it does reasonably well, I will just let it, right? I mean, I will not I will not disturb that position. And there was a reason why I kind of kept doing that, because uh, prior to that, I had, I mean, I was obviously working with Asian Paints. So again, no, I keep talking about that company for a simple reason that A, I don't hold it for a very long time. B, it's not an investment advice, obviously. C, because I worked with that, so I have a soft corner for the company for the simple reason that in the last 25 years, I've not seen companies, who perform like that, right? So going back, I had Asian Paints, I sold it too early, and then I saw it and I covered it in the seminar which I had with Ishmoit and his subscribers. It's there in the video. These companies went on to become 20, 30x and so on, right? So obviously after I sold them, uh, where I come from is uh, a lot of these companies like a Sarah or Asian Paints or any of these so-called compounders, if you call it, and I don't mean to say that Sarah is something like that, or I will still keep on holding it, is that they will go through these long periods of stagnation, or they will go through these long periods where they will not do much, and then they will spurt, right? Because obviously the management is able to do something. Not always that you will know that upfront, right? There's another position which I've had which is similar. Again, used to be a holding of our advisory. Now I hold it in a very small way in my own personal holding, which is Vinati Organics. Now again, I bought Vinati Organics in 2010, before chemical became a very a very hot topic. I mean, again, there was no major foresight or something that chemical will do this or that. I just liked the company and what they were doing, right? So I've usually not been too much into theme based investing. I usually prefer a company on its own merit. So same thing has happened with Vinati. Same thing has happened with a lot of the other companies. They will go through these spurts. They will double in a year, and then they will sit and do nothing for 2 3 years, and then they will double in a year. So you have this almost like a step function. So the first question, which you'll have to answer for yourself is, am I okay sitting with this company, which I think is the from a business standpoint is doing okay. The price catch up will take some time, and in my case, that answer has changed from time to time, but I've usually been comfortable with that, because you know what? Once you buy a company, if you, let's say, you hold 20 stocks in your portfolio, and you have three companies which are of this type, 15% is taken care of, right? Well, then I don't have to think about it. Out of my mind, they will not give me a heart attack every quarter, right? So again, that's the other thing. There are some companies where every quarter, they just I've tweeted also about this. Every quarter they will give you some kind of a like a pain, like some crap they will do, and they will just they will just you will have a you will have a brain dump on them. I usually just exit out of such companies. Like, every quarter is like a torture. And at the other extreme, there are companies who will not give you too much of a pain. If you didn't follow them for a year and you came back after a year, not much would have changed. They will quietly keep performing. They'll do well, like the HDFCs of the world. I know it's now not no longer a darling to that extent, but still, right? So I've kind of, in my own thinking, I think, let me keep some part of my portfolio where I don't have to expend too much energy thinking every quarter to quarter. What is the flip side of that? The returns will not be that fantastic, right? In terms of, over a 5 year period, there will be periods will not work. The other extreme is, I want to put time, effort, energy, comes to the same point. I'm ready. I want to time in and out. You'll make more returns out of it. So hopefully, Ankit, this answers your question. It comes down to time and energy I want to spend in that position. If you are more of an active investor who wants to jump in and out, then definitely you should do that. But if you are, you are getting to a point maybe 20 years from now where, I don't have the energy or the interest, more and more of my portfolio will move to such positions where, I don't have to spend more than a couple of hours a week. And then that's it. If it gives me 5% less than everybody else, so be it, right? So hopefully, that answers the question,
Yeah,
right?
thanks so much, Rohit. That really helped. Just one follow-up regarding the same. So is it fair to assume that because you have shared your CAGR also, which is quite impressive on your blog, and
Mm-hmm.
so is it fair to assume that CAGR of your portfolio is an outcome and you're not looking at any particular CAGR in mind? Because when you
Yeah,
have
yeah, that's
such a
true.
large position in a stock and which is slowly moving, that will
Right.
definitely hit your CAGR, right?
Correct, correct. Yeah. No, that's true. Yeah, yeah. And again, the CAGR is again an outcome of. I've never targeted a CAGR, and I think personally, I think nobody should target a CAGR. You cannot. If you start targeting a CAGR, you can end up doing some very stupid stuff. Like if you say I want 30%, like where is it written that you should get 30%, right? I got what is the basis of your math to say you will get 30%? You can target 15% because the market does 15% over the long term, and just but does not mean it will make 15% every year. But so when you're doing your asset allocation and you're putting everything in, you can say, okay, I will do roughly 15%. But above that, it's a matter of luck, timing, a bunch of other things, right? So and it will vary from time to time, right? So you may have periods of time where you will underperform, and you have periods of time where you will overperform, and it tends to average out. So yeah, you're right. This uh, uh, the it's an outcome. I've never targeted a CAGR. The rough threshold which I look at is, am I doing better than the market or not? And again, that's also a very loosely defined construct over a long period of time. It's not every year. Again, I'm talking from a personal perspective. Obviously, if you're running an advisory, your customers and your clients are very, it's very uh, valid for them to expect you to do well, right? I mean, why are they paying you for, right? So, but from a personal investing standpoint, I would never target a CHR. It should just be an outcome of your process.
Thanks, Rohit. So,
Thank you.
Prince, I can
Yeah,
go on and on, but you might be having some more questions.
yeah, okay, thank you. So, Rohit, it won't be wise to ask you for a short answer, but again, I'll read out questions for you for questions which can be, I mean,
Sure.
answered quickly, so we can take that. Otherwise, if it need a broad answer, then also it's fine. So, there are
Sure,
some
sure.
questions on okay. So this one is from again Arjun Badola. So your thought on use of technical in your investment style
Right, right,
could be
right.
for
No, that's a
determine. Yeah,
no, that's a good question. No, go ahead. Sorry, finish the. No, no, go ahead. Finish your question.
yeah. So basically, could be for determining entry price, exits, or averaging up.
Yeah. Again, I'll try to give a short answer. That's nobody can accuse me of giving a short answer, but I'll try to do that. Uh, which is why I brought up that first point, right? Time horizons. Technicals I think, are useful if you have shorter time horizons, right? But if you are thinking of 5 and 10 years, then I think you should avoid technicals, right? If you are thinking of again, I don't hold this company, but I'll just give an example because I've seen people debate about it and all that stuff, right? So I'll give two examples. Let's say you're a long-term financials kind of investor, so you hold HDFC Bank, or you're into CDMOs and all that, and you're looking at Syngene, right? And your horizon is 5 to 10 years, right? Because you inherently trust that HDFC Bank will do reasonably well. Again, uh, I don't hold either of them, so it's not a commentary on the companies. But I'm saying in general, based on their past history and their track record, and most of us know about these two companies, and you can track it, right? So let's say both Syngene and HDFC Bank, they've not given you a kind of a CAGR in the last couple of years, which other companies have given. Now, somebody whose time horizon is a year or 2 years and is looking at near term should look at technicals and say, you know what, uh, I think most people who do technical analysis will do staging of a stock, right? And they'll say, you know what, this company maybe is in stage one or stage three or whatever you want to call it, right? Where it's the 200-day moving average is flatlined, and the stock is just bobbing around it, and volumes are not high, and so on and so forth. So I will not touch it. If your horizon is 1 or 2 years, but absolutely do that. Don't enter into the stock. Flip that question around, right? Your horizon is 5 to 10 years. You believe inherently, Syngene by 2024 or 2025 will do well. They have new capacities coming up. They're getting new orders, and I don't want to time it perfectly, like just before the breakout happens, I will jump in. I'll buy, I'll keep digging deeper into the companies, ignore the technicals in both cases, and move on. So I think, again, a long answer to the short question is yes, technicals can be used, but you have to ask yourself in which scenario. If your time horizons are shorter, technicals make sense. And although I've been a value investor all my life, I've been reading about it in the last couple of years, and I'm just trying to figure out how to fit in with how I approach investing. It has value, but it has value in the sense that if I'm a long term investor, technicals, uh, if you just zoom out and say fundamentals is more about a company and its competitive advantage and valuation, technicals are about the market psychology, as it appears in price volume action, right? Market psychology will matter more around turning points, or let's say a company which you think is doing extremely well, and all of a sudden the price just crashes through the 200-day moving average and all that. Then at least it should be a signal for you to investigate deeper and evaluate your thesis, right? But if you are confident of your thesis and you think, what, this is a short term blip and the market has overreacted, but I don't care, because 5 years, 7 years down the road, my research is deep enough that I will hold on to it, then ignore the technicals. But if your horizon is a year or 2 years, then a sudden break in the price action and a breakthrough support levels and all that, maybe that makes sense to take action, exit, right? So hopefully, Prince, this answers the question.
Right. So, Rohit, like when it comes to global risk, inflation, changes in the market cycle, so the same thing goes as with technicals, the time horizon, right?
I don't usually think of it in that sense. For me, I don't look at broad. I will look at a macro from a individual sector and a company standpoint. I don't look at it from at a portfolio level. At a portfolio level, my approach is more around asset allocation. So again, it varies by individual. My equity portfolio will be, let's say, 60-70% diversified across companies, and then the rest will be maybe, let's say, bonds or real estate or another any other asset class. And I'll just play around with annual rebalancing, right? And if, let's say, I get too frightened and I'm losing sleep, my equity allocation will go down a little bit. If I'm comfortable, it will go up. But beyond that, my analysis around global macro and all that will be more at a sector level. So if there are sector tailwinds, or if there are headwinds, long term headwinds, I will look at it that way. Like China plus one, right? It's supposed to be a macro theme which is playing out, so that's there in the back of my mind. But I will look at it at a company level and see, okay, is this company benefiting? Are we really seeing export numbers go up? And it is happening for quite a few companies, right? Managements are coming out and saying that companies, we are getting more orders because of this. If that is the case, yes, then it does factor into that. But it won't work at the portfolio. I don't use it at the portfolio level. I'd use it at a company sector level.
Right. So, Rohit, the history of the market is very important. So, any one place where we can study the market history and various case studies in the past? Any one place, or we have to refer to many books or that sort of some literature?
Indian
Or
markets, you will at best you will get maybe 20 years of history at best. But I think, I mean, I don't remember any book coming out in the recent past in India which talks about the last 20 years of history. Maybe maybe it's because I am old enough to have seen that history, right? So you're asking the wrong person,
So,
maybe.
Prince, I guess a
right.
very good starting point would be you can read Rohit's blog, because you can see he has started writing, I think, somewhere around 2003 or 4,
So,
and he
so
has
let
Yeah.
me
published.
let me let me ask a question on this, Rohit. So, any plans of any books in days to come, or maybe sometime in future?
Not right. I mean, I've been asked this. Too much work. Yeah. No immediate plans. Maybe, yeah, in the future, maybe I would. Provided there is enough interest, right? I doubt there would be so much. Who wants to understand about what happened in 2000? I think very few people, right? So that's the thing.
Right. So, Rohit, I'll club two questions. Like, I want your opinion how one should go about position sizing, including averaging up and all. And apart from that, your sell strategy and how one should
Yep,
be,
yep, yep.
because selling is something which comes with regrets, right? So, how
Right,
we
right.
can, obviously, we cannot time it to the perfection, but
Correct,
again,
correct,
what
correct.
could be a better approach, right?
Right. So again, both of these questions very good ones. And again, my answer has changed all through the years, right? If you ask me 5 years back, I had a different answer. Now it has changed. Future, I'm sure it will change. On the allocation, it has been fairly steady. Comes to the my risk aversion and all that. No single answer. I think ideally, each one of us just should discover what we are comfortable with. Usually in my case, I will usually start with a 1 or 2% position. As I read, understand the company, I will scale to 5 to 7%, and then let that position ride. Earlier I would let it ride to a much bigger size, but now I usually end up capping it between 10 to 12%. After that, I start getting a little uncomfortable and I would start selling. Is it the right way to do it? I don't think so, because then you're cutting down your winners. But I've had a few bad experiences where I allowed the position to ride, and then what happened, at least in my case, was as the position got bigger, I just fell in love with that company and that position. Right? Like, oh, you know what? It is so big, and the biggest risk is not after you have bought a position and the management disappoints. I think in my own personal case, I've seen the biggest risk is when the company has done well for a good amount of time and it has become a big position. You don't marry a company. I'm just making a story about it. You don't marry a company after you buy it for 6 months, right? You marry a company after it has been there for you with for 5 years. It has become a big position. The management has done all that it claimed. You literally fall in love with the company, and then when the red signals start popping up, rationality is gone, and that's when it comes and bites you. At least that has what has happened to me. So now what I've realized is, obviously, take things with a pinch of salt. And once it starts becoming big, these biases will creep in, and then I start reducing the position. So that's one thing around allocation, right? Again, all around psychology, nothing to do with math, right? 5%, 7%, 10%, 12%, it's all individual specific. On selling, I think that is the biggest weak spot, at least in my case, because of this whole thing around Warren Buffett and buy and hold, at least in my case, right? If you have been brought up on that diet, unfortunately what happens is, people like me tend to take it too far. I think I admire traders and quants and momentum investors on that, right? I would highly recommend all of you to read, and I know for a guy who has been writing a blog called as Value Investor India, and all of this, maybe it's blasphemy to say, but then so be it, right? You should read up, how traders manage risk, how they sell, how quant systems work on that. I've been doing that for the last 2 to 3 years very extensively, and it can never be perfect. But I think now my current thought process is that you're far better off having more objective criteria on exit, because once you have held a position for some time, you have done well. Most of the times, a lot of objectivity goes down the drain. Now again, you will say, if I'm a 5 to 7 year long term investor, and I should hold it and all that. Yes, that is the case, but that should be reserved only for the very few cases, right? That should not be an overriding story across, right? It should not be, okay, you become an expert in pharma, you have become expert in IT, then that's fine, right? That industry in and out, you can analyze the company better than others. But outside of that, I think most of the times it's my sell approach is, what's the position size? Once it goes beyond a certain point, in my case it's 10 to 12%, I will start looking at it. Second is, what are the valuations of that company? A little bit of overvalued 40 30p, I'm not going to break my head. But a company which is usually sold around, I'll give an example, again, not a current position, but I think it's a good instructive example. IEX, right? I forget the full form. Indian Energy Exchange. Yeah, I think that's it. At a certain point last year, the stock just went ballistic, right? Everybody was so gung-ho about it that it was selling at some 100 times earnings or something. So there are certain thresholds where, once a company gets into that, right, like it sells at some very high valuations, which is 2 or 3 times, the mean valuation. I will get I will get very, uh, concerned, and I start selling, right? Because a lot of optimism is baked into it. And maybe the third point, which again a think an evolution or a kind of a work in progress, is that uh, I would look at around quarter earnings. I would look at what is the market reaction to the stock. The seemingly the company is has given reasonable return. Like. Uh, has reported reasonable performance. So they've had a slight miss. The reaction is brutal, right? Like the stock crashes 50%. In the past, I would just ignore it. Now, I get very, I at least, my antenna goes up, because invariably, I think, we should respect that the markets do a fairly decent job on average in detecting turning points, right? So if that happens, and if the stock really crashes, then I will dig into it and I will start thinking. And I've learned this the hard way, and I've ignored it. And so, broadly, these are the three ways I would, but a lot of my energy nowadays is now spent on thinking through, how I should improve my selling, because buying has been something which I've spent the last 20 years thinking about. So, Ankit, hopefully this answers the question.
Hi Rohit, can I ask a question?
Yeah, yeah.
Yes, go ahead.
Just I have not been in the complete space, so I don't know whether this has been asked, or you can ignore if it has been. Have you ever invested in crypto, and how do you value such a kind of an asset?
So, short answer, no, because the more I read about it, the more I could not understand about it. So uh, it I've had a few of my own subscribers as part of my advisory would share a lot of information, and I would read, and I would scratch my head, and you know I I just couldn't figure it out. Like I mean the some of the so an entire space of crypto, the at least the premise was it will be free of government interference. I can you can, it's a decentralized system, permissionless system, etc., etc., right? And then you turn around and you see all these companies backing or releasing these coins and everything. And the first thing which I would think is, but that's the foundational piece, right? Like what am I missing, right? If I tomorrow release Rohit coin, how does it make it crypto? It's not a crypto. It's just that I have issued you some funny internet money which you are valuing it. So so that was a quick one. I just ignored and didn't think about it. Bitcoin was the only area which I was analyzing, but again, there I could not just figure out. All that I could see is that it's a belief system where if everybody believes in it, it's like money, right? But the entire premise was central banks are inflating money, and all currencies will go to hell, and then that's where Bitcoin shines through. But this is what I was thinking, right? And I know a lot of crypto guys will disagree, but think of that bottom of 2020, where society was falling apart, right? Like literally, right? We all saw that, right? End of March, early part of April. What was the first thought on our mind? How to keep ourselves and our families safe, right? Did it matter whether you had a crypto or you had a rupee or a dollar or whatever in that? Your first focus was on that. So if the society starts falling apart, and really governments fall apart, do you really think a computerized currency would help you and not a regular currency? So I mean that was the thinking, right? Like when things really go to hell, a currency or something is not going to help, right? I mean it's a chaotic time, and during chaotic times, normal economic functions usually cease, right? Like the last thing people worry about is stock markets and this and that. It becomes hell for everybody. So that's my general view, right? Again, I could be wrong, right? I mean, I'm not invested, so I may be the wrong guy. There are enough arguments from a lot of intelligent people for it, so we'll see. But no, I've never invested in crypto. Couldn't figure it out at all. Forget the
Right, right.
valuation piece. It just didn't cross the basic threshold for me.
So, Desh, you can quickly unmute and ask. We are almost reaching the time, please.
Yeah.
Yeah. Hi, good evening. Very, very insightful session. And one very simple question. So, like, when, this averaging aspect has been a thing which is, like, I feel actually, so I've been in this market, but, it has been something like where you should average and where you should not average. And, like, maybe, trying to give one very simple example. Now, for example, a company looks very, very good. For example, if you come to, let's say, 2016,
Right.
17. Hello?
Right. Right. Right.
Uh,
Yeah. Yeah.
So, so let's say, for example, future retail, trading at 400, 500, and then obviously the stock goes down. And maybe at that time, because things look rosy, a person can think, let's average it. It's a good stock, it's this, it's that. So what is that? What is the
Right. Right.
trigger you see or something like that where you think averaging should be done? And because I think today it is not the time, it is my personal thing, not the time to sit and marry a
Mm-hmm.
stock. Those times are because, like, I also tell
Right.
my dad is also into this market, people telling stories about, let's say, HDFC Bank. So my dad tells me at that time people these stocks used to come at a good valuation. Today the stocks are only coming
Right. Right.
a higher valuation that you can't maybe sort of expect, and you have to take out. Obviously it is difficult to take out, but it is there, the multi baggers are there. Main question is that only, like,
Right.
how you average, what do you see? And obviously exit strategy you told, main part is averaging. Like, many a times it is not so rosy, which it seems like.
So the entire point around averaging up or down, there are two parts to it, right? The In an averaging down scenario, what you are inherently, the bet which you are making is that the market is wrong, right? And your understanding of the company and the management and the opportunity is far superior to the market. That's the inherent bet you are making. So you better be very, very clear about what you are, and it works, right? It works in cases, right? And then the a prime proper example of that is an investor like Warren Buffett, or some of these really super investors, right? Even in India also, right? People like Mr. Junjunwala, right? He held companies like Titan and Lupin and all that, right? I don't know whether he averaged down or whatever, right? I mean, obviously, that is not in public forum, not I'm aware of, right? But he held that, right? So that's averaging up is recognizing some of your own limitations and
This
using the market price as a proxy that the market knows what it is, and I have a decent understanding of the company, and the price action is also giving me a signal that my understanding is correct. Is that infallible? No. You could average up, 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 and then suddenly the stock could fall off the cliff, right? So again, that's where I come back to the same point, right? It's very contextual, right? You cannot marry. See, that's the other thing, right? Buy and hold does not mean buy and just forget about a stock. And marrying a stock also, I think, which is why when I started with the same point. Time horizons. What kind of an investor are you, right? I think that's the other thing, right? Where we all talk past each other, right? I will say, uh, I marry a stock, or I buy a stock and I'm comfortable holding 7 years, right? Because that's my basic requirement. Whereas, in your example, right, you are comfortable with a 1 or 2 year holding horizon, and it makes perfect sense for you. So again, it's you know it it's not even a debate, right? Your approach and your thinking, if your average horizon is 1 or 2 years, you will look at a certain set of companies and you will rotate in and out, and you will average according to that. If your if your horizon is 5 to 7 years, 10 years, you kind of approach companies in that way, you approach sectors in that way. Maybe it makes sense to just keep averaging the stock, because you know what, you understand the company is so good, and you've spent years and years analyzing that sector and that industry, then you can actually kind of marry that stock, because and out of 10, maybe five will work, but those five will more than work, more than make up for whatever you lose in the other five, right? So I think you should come to that point, right? Like, what horizon you are looking at, and then the answer will come, right? If you're going to hold it for a year or two, then you should be rotating in and out. And valuations, in those cases, valuations may not even matter. You don't mix up the two, right? If you plan to hold it for 5 years, valuations matter. If you plan to hold it for a year or two, then don't bother about valuations, right? So earnings growth and the technicals will matter.
So Rohit, next quick question is like the key that compounding is the key to multiply wealth, for which time is the key component. For investor who
Right.
haven't had the time to invest early, what would you advise to catch up and compound?
Mm. Again, I think question is whether you're ready to put the time for it, right? So again, you can't do anything about the time which has been lost. So I think the first thing you should do is, if you have not had the time, get into equities first, right? So whether it is indexing or mutual funds, just go ahead and start investing more and more in that, right? And then if you are starting late, then pick up a sector or two, right? Like don't bother and try to figure out 50 sectors or 20 sectors, right? Pick up one or two sectors where you have some past background or some inclination or some interest, and pick up those, right? Preferably the larger sectors, right? Not the sectors which involve too much cyclicality, right? And which does not require too much technical knowledge, right? So pick up one or two sectors, start there, right? And then start picking up sub companies there. But if you don't give time, you cannot expect to make super high returns also, whether starting early or late. You'll have to invest energy and time to make high returns also, if you're going to do fundamentals based investing.
Right.
Yeah.
One hypothetical question, like someone investing in Sensex from year 2000 once a year at the top or highest level of each year.
No idea. You might as well
Like
then pick the lowest point of that. I used to think of this in the past. I would look at what is the PE of the market and then all of that, but then I left it. I think the easiest and the smartest option in that is just SIP every month. That's it. Problem solved. No need to bother about the index level and all that. Just SIP every 1 month into the index, and that's it. The ups and the downs will get taken care of. And if you believe in the India story, then the returns will, your portfolio will do far better. And then, the balance amount of time, go have fun.
right, right.
It'll
So
be done in
Rohit,
15 minutes.
which 2-3 sectors you see have good tailwinds or potential for next 3 to 5 years?
I think manufacturing for sure. The broader theme which I'm seeing play out is that, what happened in the IT sector is now starting to happen in the other sector, which is uh, when we talk of manufacturing, when we talk of exports and all of that, I think it is less about, and so the thing which I think we've all seen in the last 25, 30 years, right? It is all about human capital, right? I mean, that has what has been the driver of growth for all the developed economies. And I think that is what will drive the growth for India also, right? We have a lot of human capital. And when you talk about manufacturing or China plus one, it's all around that, right? And what is pharma, right? It's human capital, but packaged in a pill, right? I mean, that is what it is, right? Otherwise, anybody can make a drug, right? I mean, not in that sense, but at least, in a sense that anybody can manufacture aspirin or whatever it is, right? But it's around the processes and the knowledge and all of that, right? So it's that human capital packaged, a cheaper human capital, or high quality human capital, but at a lower cost. So that's spreading to manufacturing, that's spreading to a lot of other sectors. So again, I think manufacturing and export sector, I think a lot of things are coming in place. Second, the digital space also, again, it got beaten down in the last a year or so, but if you see the way the history plays out, right? Dot-com boom happened, then the bust, and then the build out started happening. So I think that space will definitely do well in India. Again, I don't have any investment in that space, but the whole digital infrastructure which India is building is far superior to most other countries. Like, this is one area I think which is kind of underappreciated. I think what India has built in terms of the digital stack really phenomenal, right? Most of the countries are a few years behind. So I think that's going to be a big area. I think real estate over the long run should do fine. A lot of good things are developing as a percentage of the as a percentage of the capital inflows. I've been positive about it for the last couple of years. I think it's going to be a big thing that will again, that's my again, that's a very wide space, so you will have to kind of narrow it down to areas which where we have more, companies have more of a niche or an edge, right? Not like, oh, you can make steel in the bulk, right? It's not about manufacturing in bulk. I think it's going to be where you can apply knowledge, right? So for example, maybe in a bearings company, or in a API drug, or maybe in research or things of that sort, right? Where you can apply knowledge in a very narrow as in, not in the broader sense, but in a specific niche, and then be world class. So I think that's another area, and there are a lot of companies in that space. Could be specific chemicals, could be specific drugs, could be APL Apollo, I just as I spoke, right? It's a small space, right? Steel tubes, right? But there is an advantage which the Indian company has. Again, not a recommendation, just need to say that.
Right, Rohit. So, Rohit, like the IT sector has seen drawdown in last 1.5 year or so. So, how you
Right.
see this sector panning out from here?
It's become partially a cyclical sector, right? IT used to be like it happens with other sectors, right? It had its secular run up till 10 or 12. Now it has its own cyclicality, right? It goes through these cycles. So we had a down cycle maybe till 2019, then it has an up cycle. So now it has a drawdown, and with all the macro headwinds and all that, there will be a slowdown, and then again, it will have its up move. So again, I know it's a minority view, or maybe people it's moving closer and closer to a commodity than, there are niches for sure, right? And if you can find a few niche companies which are doing exceptionally well, that is good. But it's moving. I'm not saying commodity in that sense. I'm saying commodity in a more cyclical sense. I mean, the companies still earn a very healthy return on capital, but they're slowly becoming more and more like, the steady cash cow kind of companies, right? Giving high payouts. Think of it moving closer and closer to a domestic pharma, to a FMCG companies, right? FMCG companies still have a more secular growth, low but secular growth. I would not be surprised to see IT companies give a similar secular growth, but in a slightly more cyclical fashion. So if you take a 5 or a 10 year horizon, they'll maybe end up with a 8% CAGR, 10% CAGR growth, but it will not come at 7 plus or minus 2 every year, right? It will come more like 5 plus or minus 5 or something like that. That's my view. So compared to an FMCG, obviously the valuations are much lower. But you'll have, if you want to make slightly good returns, you'll have to time it. You'll have to get to a point where the cycle has bottomed out, and there is quite a bit of pessimism, and people are again moving out from the sector, and that's when you move in. So it's more of a cyclical play than a secular play in my view. Again, you can find niches in that where either you're a product company, or into some sort of like a outsourced engineering research or something of that sort, and those will be more of a secular grower.
All right, sir. So last three questions, one line answers, right? So because we
No problem.
already took more than which you told us, yeah. So
No
which
problem.
is who is your investing idol apart from Warren Buffett? One name.
uh, I not an investing idol, but I've been a big fan of Charlie Munger, and and it's more less around investing, but more around general philosophy of life, and the way he thinks, and the way he's rational, and he's very blunt, right? So he's my second idol. But outside of that, I mean I've my idols have now moved beyond investing, but yeah, in that sense, Charlie Munger.
Okay. Any book in Indian context which can be a very helpful guide for investing?
I would say go back to the original classics, right? If you have to read something on fundamental investing, read The Intelligent Investor, and read that. I've not found any books since then which are better than that. And Common Stocks and Common Profits by Phil Fisher. Read these two books, right? It will take care of 75% of what you need to learn about basics about investing. Then majority of the books are just fluff, and they go round and round and just beat up the same concepts again and again. Basic concepts are not very very elaborate. You read these two books, and you should be you're almost 75% to 80% done. Again, I'm
Okay,
talking
so
of fundamental investing. If you
right,
are
right,
into
right.
technicals and all that, then obviously you can find a couple of books on that. Yeah.
So your what's your allocation across other asset classes apart from equity?
I just keep, real estate, personal this thing, 10, 15%. I'll have debt, 10, 25%. I don't do, gold and crypto and this and that. So for me, it's mainly three asset classes. And I found equity to be the area to be my sweet spot. So it will be 60, 70%. And then real estate, obviously, personal house and this and that. And then the whatever is left over is in, fixed income. And again, I get asked this, but I've told all my subscribers very clearly, I don't even get, even remotely aggressive on debt. I don't reach for yield. I'll just go and put it in a fixed deposit and I want to sleep well, right? So I don't care about that additional 2% yield for which I'm taking 3x the risk, right? So there's no point in taking risk on the debt side or on the real estate side. I'll just do the bare minimum and then I just let it be at that.
Right, sir. So one last yes or no question, sir. Pawan Yadav is asking, can we generate 12% CAGR by investing in Nifty ETFs doing SIP?
If the country does, we are what? 6% inflation, 7% inflation, right? Let's say 6%, right? So do you believe that India will grow at 6% or maybe 5% GDP growth? And then Nifty usually does 1 or 2% above that, right? So so what you're asking is, can India grow at 5 to 6%? I think if you were to ask me, I think the odds are yes, it will do 6 to 7%, right? So you add 6% inflation and you add 1 or 2% extra on that, right? So that's your answer, right? That how you will think. And by the way, that's how you can think about a lot of things, right? Reason from bottoms up, right? So think about, okay, what does Nifty returns mean? GDP plus real returns, real returns plus inflation plus 1 or 2% extra. And if you do SIP, it will add another 1 or 2%, right? You're talking of 5%. Can India grow at 5%? I think, yes, most likely yes, right? So yeah, the answer to your question based on that logic is yes. Will it happen for sure? We don't know, right? But at least the odds are there, right?
Great, great. So thank you so much, Rohit sir, for your time. We are almost
No
three
problem.
hours, and I don't feel like let you go. But again, the time constraint we understand. And thank you so much for
Yep.
agreeing to my request. And it was really, really insightful. I'm getting so many positive comments. I know the good thing is we had a session with you, but that comes with the regret that due to the initial glitch, this session was not recorded.
No
And
problem.
I think the person who are attending till long, I request them, if they have made notes, kindly put a thread so that those who are not able to attend for any reason, they can revisit. And then again, I came to know about in between the session, I asked one person to record, so maybe it is part recorded that I will
Sure,
be
sure.
sharing with everyone. So thanks again, sir. We look forward to more such sessions depending upon your willingness and availability. And it was really,
Absolutely.
really insightful. Any
Yep.
concluding remarks on your part, sir?
No, I think it was great talking to you. Very good questions. I think, we didn't get into specific companies and all that, which is fine. I think we can do that in a subsequent session. But yeah, very good questions. And, thanks for everybody for listening in and taking their time out on a Saturday evening when, you could have more interesting things going on elsewhere, right? So, yeah, thanks a lot.
And sir, I can relate like the accidental investor thing. It was also accidental entry for me as well. So I can relate. Most of the people attending here are more or less into investing by chances, or as you talked about,
Correct.
serendipity. So thank you
Yep.
again. Thank you everyone for keeping for so long. I see many familiar faces, Rajat sir, Dhaval, and the disciplined investor. So thanks for keeping for so long, Ankit Bhai, for your smart questions, and Vajpayee ji. Everyone who attended today, if you like our session, please do let us know. And if you have any positive or negative feedback, do share with us so that we can improve on that. And our sessions are purely educational, no sort of commercials involved, and there are no buy sell recommendations. If any names taken during the conversation were purely for illustrations and more like case studies. So thank you so much, and we'll keep coming with good guests and learned people like this. Keep supporting and be